Hey ladies and gentlemen, welcome back to the channel. As always, it is Nick here, back with your daily crypto news and analysis, and today we're going to be talking about the coming recession. So sit back, relax, and before we fully jump on into this video, if you guys do enjoy this video, if you guys learn anything from this video, definitely hit that like button at any time in this video. Also, if you guys do enjoy this content, definitely hit that subscribe button and turn notifications on to never miss a future update. Now, with this in mind, of course, I've been addressing the indices. I've been talking about the S&P 500, the Dow Jones, and even the Nasdaq for some time. Obviously, these are not open today. They won't open until Monday, but they did look pretty rough on the closing on Friday. I'm hoping for possibly some sideways momentum on Monday to actually bounce back on roughly Tuesday. I don't believe that the recession is here just yet. I think economically we will most likely kind of save the markets until around Q4 of this year to Q1 of 2023. But I foresee a recession happening, and we're going to be talking about why. So let's dive in and let's talk about a few things. So I'm going to be talking about these three charts at the end of this video, kind of comparing and contrasting like 2008 to now currently. But we also look at the 10 years. So I've been talking to you guys about the 10-year yield for a while. Obviously, this kind of shows you guys not only mortgage rates and things like that, but also it does show you buyer confidence around risk on assets. When we look at this, this is actually an early warning sign of possible crashes happening within the market. More so, I always kind of compare this to 2020, the March of 2020 crash. So here we have, roughly us topping out around like 2019 into 2020 of January, with that crashing point, happening in March. Now, I do watch the 10-year to see if it's going to show some signs of weakness, topping out, possibly even having that 180 turning point where it kind of just falls down, because this could actually tell you to get out of some risk on assets, jump into possibly the dollar, and reinvest into things when they do kind of drop. Now, the issue here is actually the dollar. Which I've also been addressing, for some time on this channel. When we look at the US dollar, it looks pretty strong, and I've been addressing that, kind of comparing it to 2020, and really kind of saying, what's going to happen with this as we do kind of, look at this. So, when we look at the percentage increase from those bottom lows from the 2018 timeframe, it was roughly about like 16.7%, and then this kind of collapsed about roughly 13.37%. And now we're kind of seeing if we are going to repeat this pattern or if we're actually at around the local topping point for the dollar and we're actually going to turn over and die here. I've actually been addressing a possible topping point at the same point that we did back in March of 2020. But, this is the idea that individuals are actually holding on to the dollar as we do kind of see uncertainty flooding through risk on assets, more so stocks and even crypto. Now, again, we know that the dollar itself during the 2007-2008 crisis actually increased drastically. So, here we have a crashing point for the US dollar. It actually bottomed out around like 2008, March of 2008, and it started to gain momentum during 2008 into roughly like 2009. As you guys do see, this is really kind of topped out in 2009. Now, do I foresee this happening again where we do see this drastic increase during a bear market, aka a recession market? Yes, most likely. But I do think that we could see something similar to the 2005 timeframe where we kind of have this massive drastic decrease in price. Now, I don't think, or value, I should say, not price. I don't think that this is going to happen for years. Like, this was a 3-year bear market from its topping point to its bottoming point. I don't believe that that's going to happen. I don't think it's going to be that long of, a decrease in price. I think it's going to be slightly a decrease in price by, something similar to like the 2009 time frame into that massive spike in 2010. So something similar to this would be, welcoming on the dollar right now for those individuals to get out of risk on assets, kind of jump into other things like, gold. Things that are kind of, physical, hard assets are the way to go during a recession. Digital assets and stuff like that, I foresee having a nice spike in price as well. I actually think that when we look at crypto and stocks, more so centered around crypto, because I actually don't, touch stocks all that much. I am in a few like pharmaceuticals and also like marijuana stocks, as we do kind of see a shift in that market. But when we look at crypto, what will actually push crypto is a possible recession. Because I think it's going to be the idea on individuals wanting to get out of the US dollar and jumping into something that they could, find value in. And I've actually always said this in terms of cryptocurrencies. We kind of look at DeFi that could offer APY percentages for individuals holding. As we do kind of see inflation jumping to about like 8.5%, right? That means the average US individual's bank account is actually dropping 8.5% in value, in 1 year. So again, the more money you have in a bank account, the more loss you're actually taking. But also think about it like this. Why would you want to hold that money in a bank account, losing 8.5% when you could actually gain 8.5% in some APY staking? In fact, in DeFi, in crypto, now of course not everything is secure. I know USDC, coin staking on, I think it's on Coinbase, it's like 5% APY. There's some like 13+% APY in this market as well, like Casper and stuff. There's some great opportunities within crypto to actually stake your crypto and earn a significant percentage yield that is way more than, of course, inflation rates. That's the way to go, and that's where a lot of U.S. individuals are most likely going to focus their shift when we do see the nearing factors continue to be, I would say, spotlight it, because we are kind of seeing a spotlight being put on a recession right now currently. I mean, when we look at things happening around the world, right, we do see a recession warning as confidence among shoppers fall to the lowest since 2008 financial crisis. This doesn't, surprise me. I mean, we've been seeing a significant decrease economically, especially in economic growth, right, for a while now. And when we look at this, right, we do see and economists are warning that much worse is likely to come with the impact of huge increases to energy bills and rises in tax and national insurance yet to hit. Official figures released on Friday showed retail sales fell 1.4% in March, faster than February's 0.5% drop. Online spending was down 7.9% as the lifting of COVID restrictions saw people return to buying in stores. Now, as we do kind of see this, I mean, confidence will most likely drop among a lot of, economic growth areas. More so, again, businesses will be taking a lot of hits. I've actually been seeing businesses closing their doors around me locally, which kind of reminds me again of 2008 when we did see a lot of, businesses kind of boarding up their shops and, kind of moving. They closed down, and, we also seen that becoming a big deal. But also we do see here, global bonds fall $2.6 trillion. It's worse since 2008 financial crisis. Again, things are being printed evidently more and more clear day by day. We actually do see here the 11% drop is the worst since the 10.8% slide during the 2008 financial crisis, which is pretty significant. I would say as we do even see the Federal Reserve continue to raise interest rates, even that 0.25%, it's not a significant amount, but as you kind of see inflation, continuing to rise, and we see the possible signs of, recession nearing, raising those interest rates is only going to cause a recession to be a lot worse. And this kind of goes back to even 2008 yet again. So, when we are watching things like this unfold before our eyes, it kind of makes the typical individual kind of rush to, prepare for what is going to happen. I mean, honestly, I would say that the best way to prepare is to hold things that are hard assets that kind of are disconnected from the economics of the U.S., but it's hard to find anything like that. I would say the best way is staking. I mean, that's what I pretty much am looking at, because when we look at staking opportunities, they are fairly well. Will they drop in a bear market? 100%. So it's not, a foolproof, sort of way to escape a recession. Now, of course, is a recession going to cause everyone to lose their money? Is everyone going to go bankrupt? No. But again, a financial crisis could last, months. It could last years. We don't know specifically how long this one will last. We know the 2008, crisis was pretty rough, and there's still a lot of individuals out there that haven't bounced back since then. We also see our UK consumer confidence falls to lowest level since 2008 financial crisis. The cost crunch is really hitting the pockets of UK consumers. We've actually been seeing a lot of warning signs around the UK in terms of inflation rates, rising as well. We do see here when rising inflation and interest rates meet low growth and declining incomes, aka economic growth has been slowed. Consumers will understandably be extremely cautious about any spending, and I think that that's actually what's happening right now, even with economic growth within stocks and crypto. As we do see the 10-year yield, it's really kind of printing us the fact that there's a ton of buyer confidence around risk on assets. We're just not seeing that money flowing out of the dollar into those areas, which I think that we will see eventually. I think it's just going to take some time until we do see the dollar really kind of dropping in value, and I think that that drop in value will become the idea on individuals jumping into risk on assets, similar to what we did see during 2017 into 2018, which, by the way, this was a massive bull run for crypto and even stocks. Now, also, we do see our breaking news. Canada's inflation rate soars most since January of 1991. Annual rate of inflation hit 6.7% in March. Also, at around this time, again, we do see the IMF is warning of severe pressures in commodity markets in a financial stability report. JP Morgan is reviewing commodity exposure right now. Who said commodities were boring? And then also, we did see the Bank of England, right, says he is concerned about the risk of, persistent inflationary pressure. This is coming from the governor of Bank of England. Now, again, when we talk about what is happening, I would say that, economic growth has been stifled greatly. And this actually started to happen and occur during, again, 2020 with COVID. I don't think that we've actually bounced back strongly since then. Of course, yes, there has been a lot of, economic growth within stocks and things like that. But inflation rates have been drastically increasing since then. We have been seeing spending drastically increasing since then. 80% of the US dollar in circulation has been printed in the last 2 years alone. I mean, would you say that the US dollar is the safest asset to be holding right now? Absolutely not, especially in terms of stability. And we also see here the Federal Reserve of Dallas warned a few weeks ago of a housing bubble. You can't make this stuff up. And as we actually did see this warning, it followed with mortgage rates in the United States climbed to 5.11%, highest since 2010. The Dallas Federal Reserve had remarkable timing on their housing bubble warning. I know a lot of people are running to buy a house right now. I would say right now is the worst time to buy a house. This is 100% a seller's market, as we do see individuals, trying to jump into buying a house. Honestly, those individuals that are jumping to buy a house right now could possibly end up having their house owed to the bank. This is what we also seen in 2008 as well. A lot of houses were actually up for foreclosure. The bank owned them. And, I'm kind of seeing a pattern being printed here again. And, a lot of people still believe that we have not bounced back since 2008. And I would say economically, the economic growth since then has been fairly, I would say slowed. But things like COVID really slowed everything down. And we are seeing a massive issue currently within, the United States, where we kind of look at things like the supply chain being disrupted. All of these things lead to a recession. We also see here the U.S. Treasury Secretary Yellen, I do not anticipate a recession in the United States. Usually when these individuals are telling you guys this, it's to pretty much play the safe game. Hey, don't panic. Things are okay. Things are okay. Things are okay until things are not okay. We've seen this in 2008 as well. There was a ton of warning signs around a recession. But again, everything was being printed as everything's okay. Everything's okay. We also see here, in case you missed it, Canada is headed for a recession. Economists say there's warning signs around the world right now. I would say when we talk about a recession, it is nearing. The timeline for this, I would say, is roughly around, the end of this year into 2023. A lot of people are constantly saying, when? I mean, things are looking pretty rough, right? We look at things right here. The Fed has been in rate hiking cycles 13 times since 1955. Result 10 to 13 end in recession, hard landing. The three green arrows highlight the 3 times Fed rate hikes did not coincide with a recession. Conclusion, buckle up, right? Now here is those 3 times. But you do see something pretty interesting, right? So the hard landing that, drastically happened after the green times, okay? was roughly around like 3 to 4 years apart. We look at the last time that rates were really kind of increased in terms of a hard landing happening was around 2019. We are nearing that 4-year term. I would say when we look at this, the 4-year term is very, very close. I would say 2023 is the time to really kind of watch this. When we talk about inflation, inflation is out of control. I don't believe that we are in an 8.5% inflation rate. I think that the inflation rates are much higher than they are letting on. And when we look at the current structure of inflation on this chart, we do see that 8% being printed here. It's the highest inflation rates since going back to 83. Okay, now mind you, in 83, this figure actually drastically increased to almost 15%. I would say that we're probably at around 15% right now, and they are not letting on the worst of it all. We are seeing food prices, gas prices, rent, everything is increasing drastically in price. They were saying inflation rates are only 8.5%. Gas is up 50%. Rent is up 50%. Consumer products are up massively. You go to the grocery store, $20 barely gets you anything now. When we look at the cost of goods, things are out of control, and inflation is not slowing down. In fact, we are continuing to print, and now we do see warning signs of a possible, another lockdown, more COVID, strains coming. When we look at this, what is going to be the slow rate for, again, printing? It seems like there is no sign of hope in store for us. And this takes me to, again, the last portion of this video, which is me talking to you guys about the crashing points. So, we look back on time, we look back at the dot-com bubble, we look at the 2007-2008 crisis, and then we look at the 2020 crash for March. Roughly between 38 to 54 to 38%. Now, the next crashing point, first off, I don't believe that the Dow Jones is at a topping point. I actually think that this is not too bad where we are currently. It looks like we are at that support zone going back as far as like October of 2021. If this does top out roughly around like 40,000 to 45,000, I would say roughly like 40,000 most likely will be our topping point. I actually foresee a deeper correction than 54%. This could be met, I would say, with roughly a 60+% correction to possibly test those support zones going back to 2015. And if that does not hold, we will actually come back down and test some support going back as far as like 2011. Which could possibly be met with a 70+% correction along the board. So prepare yourselves for a recession. Even if it doesn't happen, it's better to be prepared before anything does happen. Because I would say this, right now, in terms of stability, I would say the chances of a recession are far greater than 60%. And when we talk about the US dollar being stable, it's nowhere near stable. We look at the S&P 500 as well. Similar to the Dow Jones, right? We go back in time to that 2020 crashing point. Again, this was roughly, 35% of a decrease in price. We go back to 2008. Here we have it, topping point roughly around like 2007. It was actually like around October of 2007. This was a 57, almost a 58% decrease in price. Dot-com bubble. Right, here we have it. Again, roughly the same economic structure. 50% of a decrease in price, followed by 57, almost 58, followed by roughly only a 35. Now, the reason why I'm showing you guys this is during this crash in March, do you guys remember the panic that ensued along the boards for economics? It was rough. Now, think about a 50+% correction. Think about even like a 70+%, correction. I foresee this topping out around roughly like 52 to 6,000. Even if we met in the middle at roughly like 5,500, I know it's not exactly 5,500, but if we do see, a deep correction, we'll say 50%, it's almost testing, some support, but there's really nothing there. If we bounce off of the lows from 2018, we're still looking at about a 57% correction. If we go back to 2016, it's 65, almost 70%. I would say a 70% correction along the boards is something to really kind of watch for. Now, a 70% correction would actually have us topping out roughly at around 6,000, which is why I do believe that that would be our most likely area to top out on the S&P 500. Some more growth left in store for us. Maybe a little bit of a bounce back, make things look like it's all good. We've seen rallies before, again, these massive crashing points. And I'm not saying that we haven't rallied. Trust me, off of those March of 2020 lows, we drastically increased in value. I mean, look at this. From those lows to the topping point, we actually rallied about 118%. So I would say when we look at this and we look at the past rallies, like even going back to like 2019 where we had this nice little correction, this rally was roughly about a 45% increase in value before we had that correction, which this was a crash, by the way. I mean, this was the COVID crash. I would say when we look at the things happening right now throughout this market, I would say, when we look at the fib outreaches for some of these charts, it really kind of prints a little bit of a better picture. 6,400 could possibly be our topping point, which still, it still kind of shows us, even at, roughly a 70% correction, this would be about like 71, almost 72. It would test that support going back to 2016. Even if we tested the, March of 2020 lows, it's still roughly about a 66% of a decrease in price. This would cause a massive crash. This would actually cause us to go into a recession. And, we have been seeing a lot of warning signs around the world. We've been seeing, sort of the play into the idea on, hey, everything's all good. We see this even on CNBC. I don't know if you guys watch CNBC. I kind of watch it here and there to really kind of keep up with the markets. But we just hear, I think the bear market is over. Makes a bold call in tonight's Talk of the Tape. This is Jim Cramer. Then this follows by 1 month later. Jim Cramer says if the U.S. does enter a recession, it'll be mild. Honestly, no, it's not going to be mild. When we talk about economic growth, it has been slowed greatly. And we are seeing the warning signs being printed evidently more and more clear day by day that a recession that is coming is going to be the worst in the history of recessions. It looks very rough. I would say inflation rates are drastically higher than where we are currently. I would say this is probably going to cause a massive decline in a lot of economic growth for years to come. I mean, even if you look at the 2008 crisis, for the Dow Jones, for this to get back into the point of relief, which was, by the way, 2013, this took roughly took 1,500 days to get us back into the green. That is significant. Now, in order for us to get back in the green on the Dow Jones, if we do have this 70+% correction, maybe even if it's, again, a 50+% correction, maybe even at around testing the 2016 support, 62% of a decrease in price. How long would it actually take to get back into this point? I would say it's going to take years, and it's not going to be mild at all. And we also do see here during the past 80 years, the Fed has never lowered inflation as much as it is setting out to do now by 4 percentage points without causing a recession. This is the focus point. How will we determine lowering inflation without causing a recession? It is near impossible. So with that being said, I would say prepare. Try to get into things that are going to help you economically. Like I said, I'm kind of sticking to my guns with, earning APY on some, staking opportunities, holding some gold, holding some hard assets, even protecting your digital assets on some ledgers. That's something that I also like to do. But ultimately, things are looking pretty rough right now in terms of economic growth. I don't believe that we enter a recession until around the end of this year into the beginning of 2023. So I do think that we have some time to still prepare, still make some money off of crypto and some stocks and things like that. But for the most part, I hope that you guys enjoyed this video. If you guys did, definitely leave a like, subscribe, turn notifications on if you guys want more free content. You guys are more than welcome to follow me on Twitter and join the free Discord down in the description below. As always, up to you all. Have a beautiful day or a beautiful night wherever you guys are in this beautiful world. This has been Nick. Peace out, guys.